Hello everyone and welcome to Fun with Fitzy. We are on the third video of Chapter 11. Chapter 11 is not too long, except for the first two videos were quite long. As you recall, we are talking about current liabilities, and we've already talked about definitely determinable, and we've talked about it estimated. Indefinitely determinable, we had HST, we had notes payable, we had salaries and wages payable, we had unearned revenue, things like that. And with estimated liabilities, we had property tax and warranties. So now with contingent liabilities, we're going to talk about what they are and how to handle them. So definitely determinable liabilities, we knew what the amount was, who we had to pay, and when we had to pay it. With estimated, we knew we had a liability for sure. We didn't know the amount for sure, and we didn't know necessarily when. However, with contingent is even more gray. They exist when there is uncertainty about the outcome. So we don't know if you'll have to pay or not. It's contingent upon something else happening. So contingencies are accrued by a debit to an expense account and a credit to a liability account if both of the following conditions are met. So what we're saying here is, for contingent liabilities, you are going to debit an expense account and credit a liability, a current liability, but both of these conditions have to be met. And if they're not, you will not do a journal entry at all. It will be treated differently. So the first condition is it has to be likely. So you're pretty sure it's going to happen. And the amount of the contingency can be reasonably estimated. So let's talk about some examples here. An example of a contingent liability would be a lawsuit. Companies get sued sometimes, unfortunately. Think about Toyota when they were having the trouble with the cars accelerating, and I'm sure people got hurt and people are suing the company now. So Toyota has a situation where they think they may have a liability, which means they may have to pay people money. But they don't know whether or not they're going to win the lawsuit. So they have to go through this process here, basically whether or not the contingency is likely. And if they think it's likely they're going to lose, as well as they have to estimate. So if people are suing for $1 million and they think it's likely they're going to lose, then both of these conditions are met. And so now they're going to have like a lawsuit expense and then a lawsuit payable. And if they're going to have to pay it within the year, it's going to be a current liability. So that's what we're talking about with current contingent liabilities. So what I'd like to do is draw a little table for you to make sure that you can understand what to do in the situation of contingent liabilities. So I'm going to have journalize, and we're going to call it accrue because really it's an accrual because we're not paying it. Or we're just going to say disclose in the notes. So we know that if it's likely there's going to be a situation, it's likely and you can estimate it. And if it's reasonably estimatable, then you're going to accrue. However, if it's likely, but you can't estimate, you have to disclose in the notes to your financial statement because the accrual will be really difficult to do. So this means you're going to have to put a note with your liability saying you might have a liability, you just don't know how much. And as you can imagine, that could really impact your income statement because you don't have the matching expense, as well as your balance sheet, so your equity would be a bit off. If it's neither likely or estimatable, you should probably still disclose it in the notes. There's another situation where it might be unlikely, but if it happens, it's bad. It has a substantial negative effect. You should still disclose it in the notes. So that's how you handle contingent liability. So let's talk about the lawsuit again. I remember Fisher Price Mattel had something called Polly Pockets. Some of you will know about these. These are those little dolls that look like Barbies, but they're a third of the size. And these Polly Pockets had these little magnets on their bodies right here. And the magnets were so that the kids could stick these clothes on them. I'm drawing a shirt, and the shirt had a magnet, and the shirt had two pieces to it, so there was the front and the back, and it would just snap onto the doll. This piece would snap on here, and this piece would snap on there. But what was happening was these magnets were falling off, and kids were eating them. And if you can imagine a magnet, I'm going to draw an intestine. This is a human intestine going in. Well, guess what? In the most part, it would just go right through and come out the other end. In and out. However, some kids who ate two magnets caused problems because what happened was their intestines then smushed together. Let's see if I can grab my eraser and fix this here. Oh, that was a big eraser. Their intestines squished together, and they had two magnets stuck together in their intestines now, and nothing was getting through, so they had a blockage. So several kids got really hurt. So let's talk about Mattel. They were sued, and they thought it was likely that they were going to lose this lawsuit, and it was reasonably estimatable because they knew how much it was going to be for. So they had to journalize and record this as an expense. However, if they didn't, they thought it was likely, but they can't estimate because they didn't know how much. Maybe they were just filing the lawsuit or something, and they hadn't actually gone through it. They had to disclose in the notes that they knew this lawsuit was forthcoming. What if they felt that the lawsuit wasn't likely, they weren't likely to lose, and they couldn't estimate it? They still have to disclose in the notes so that maybe an investor thinking about Fisher-Price Mattel as an investment would still know about the situation. No surprises in these public traded companies. Okay, by now you should be able to account for contingent liabilities and determine the proper course of action based on that table we just built. Thanks for watching. See you next time.